Well, good afternoon. Thanks for taking some time out of your day to listen in to my mid-year webcast titled Gravity. Today's webcast is a follow-up from my December webcast titled Prepare to Land. And in it, I suggested that the Federal Reserve was going to be slow to lower interest rates during the year in calendar year 2025. So far, the Fed's not lowered rates, and there's no anticipation that that's going to happen before the September meeting. Also today, I always like to cover markets and the economy. I'll also have a focus on those asset classes that are performing well as those that are lagging, and also talk about geopolitics a little bit in today's webcast. Just by way of performance updating, the stock market is up on the year, about 3% as of today's close. Interest rates all across the yield curve are still around the 4.5% to 5% level, depending on the maturity. Also, I'll note that the price of gold that I've been focusing on in recent years is actually the top performing top performing asset class rather on the year thus far. It closed up 27% on the year, and the precious metal mining equities are up approximately 50% on the year thus far. I've had this thesis that when commodity prices turn up for a long enough period of time, that creates inflation in the economy that the central bank eventually has to deal with. And in those environments, the broader indices like the S&P 500 and the NASDAQ tend to struggle. And I'll talk about the reasoning for that historically in today's webcast. Just understand that as we look at these things, I don't profess to know the future, but I try to really study the past historically to try to get an idea of how investors ought to consider developing their portfolios for risk management purposes. And so when we see things repeat historically, I try to bring those to your attention and tell you what are the risks and the areas that are attracted to me when I take you through these webcasts. Also note that if you request a copy of the slide deck from any of these webcasts that I do twice a year, you can actually go back on this second page and watch any of them. They usually run about 30 minutes. You can see the content that was discussed in each one of them. Also note that these webcasts are designed for clients that include accredited investors, high net worth individuals, as well as qualified plan sponsors and their participants of 401k plans and the like. So with that, I'm going to do another three-part presentation as I did in December. I'm going to focus on these three things, which is really the economy's growth rate, what we've been seeing and what's in the forecast, what inflation's doing, and then what both fiscal and monetary policy are doing and likely to do. And again, as I said at the beginning, I want to talk about market risks and opportunities that I see as an investor, and then also provide some ideas of expectations for the balance of the year, and then also thinking about positioning for 2026 a little bit as well. So looking at the economy, I mentioned this in the December webcast, this data point called GDP, is the economy growing or not? That's gross domestic product. That's what you typically see referred to in measuring how the economy's doing. And I always like to remind you what is in that calculation, because it's pretty important to understand. And it's the following four things added up. C is for consumption. That's consumer spending. 70% of the United States economy is based on consumer spending. So when consumers have more money in the pockets, we tend to spend more. So that's one measurement of it. I stands for investment. So when a company, for example, relocates and builds a new facility or is expanding and builds a new facility, that we consider that investment spending. G, which I'll focus on, is government spending. And as many of us are well aware, the government has had an increasing influence in the economy because they're running these huge deficits, and they're doing so under different administrations to try to keep the economy expanding. And so I'm going to focus on what that's been doing in recent years in certain areas. And then also the final component is looking at net exports. Net exports is taking all the goods and services that we export abroad minus anything that we import. And so that net amount nets that out. So as you look at the bottom We're going to look at the left-hand side first. We're looking at real GDP, that's in GDP as it's reported after inflation on a quarter-over-quarter basis, and then year over year. And what we can see is that after inflation, the economy has been growing. There was an anomaly in the first quarter of this year because you had a significant amount of gold repatriation come from overseas locations back into the United States, and that counted as an import in the calculation, which created an artificial decline, I would say, that's not going to be there more than likely in these following quarters in 2025. You can also see what inflation's been doing in terms of the headline CPI number going back over the last 3 quarters of 2024. And as I noted back in December, I felt like inflation would continue to moderate, which is just not to say that prices are outright dropping. They're just not going up very fast. And again, the Federal Reserve, which I'll talk about in a little bit, is using inflation measures to determine what their monetary policy should be in terms of how tight or loose with monetary policy. And so that's important to keep monitoring. And what we're seeing, at least what's forecast for both GDP and inflation, is that it's anticipated we'll see GDP continue to grow the balance of the year, while we'll also continue to see inflation stay below the 3% level on a quarterly basis as reported year over year for the balance of the year as well. Going back to government, I said I wanted to focus on the influence of government because government spending and where government spending's been going has been not just alarming if you've been watching what DOGE has been doing under the Trump administration, uncovering fraud and wasteful spending that it seems like nobody in any political party has been very aware of, but also looking at the impact on what the immigration data has been showing, and then also the impact of what the government job increases have been showing to the overall job reported numbers that we've been getting in recent years. So for example, if you look at 2023 and 2024 non-farm payrolls that were associated with new hiring for government jobs, what's interesting about that is historically that number of government jobs in that non-farm payroll data has never been above 5 or 6%. In 2023 and 2024, those were 22 and 28% of the total jobs reported in the non-farm payroll number. And that's important, again, because we're seeing a new administration come in and trying to make some changes. So I think it's helpful to have the context of where they're coming from the prior administration. Of course, it's no secret, too, we've seen a big impact in terms of net immigration of illegal and legal immigration in recent years. And so just to give you some perspective, historically, we normally don't see more than about 1 million net immigrants, which is looking at those people that come in minus those people that leave. And in 22, 23, and 24, that number jumped from almost 1.7 million to 2.8 million per year of net new immigrants coming into the country. And then finally, I think it's also of interest to see where the jobs went, not just in terms of government jobs or private sector jobs, but who got them. And foreign-born foreigners that came into the country actually got 3/5 of the jobs relative to native-born citizens over these last 3 years. And again, those are just things that I think we need to understand, regardless of your political leanings. Those have been influences on the GDP data. And now we've got an administration under the Trump administration that's trying to reverse that. And I think it's helpful to understand that if they're successful, what does that mean for the GDP data? So that's the context that I'm coming under here. So what we can see now that we're in a new year is we've got a downtrend in wage growth, which is reducing wage-related pressures. And of course, that's one of the things simply because the job market was tight and now it's beginning to become less tight. I would not say the job market is loose necessarily, but generally speaking, we're seeing those pressures as a result of a lot of those government jobs that were instituted in the last 3 years start to wane. Another thing that I think that's also helpful too to understand as it relates to the implications for the economy and the financial markets is what's the current administration's primary goals. And so the Trump administration, if you were paying attention to the news, they recently had three key objectives that they wanted to focus on. And one is to depreciate the US dollar. Why do that? Well, number one, to make our exports cheaper and more competitive, and also make it more expensive to us to import things into the country. And the reason to do that, of course, if you were to ask Donald Trump, is to try to revitalize domestic manufacturing. Number two, our US debt. It's no secret that the US government, and really even the private sector too, is excessively indebted. And so this plan proposes to getting foreigners, at least our foreign allies, that is, to be willing to convert their treasuries that they own as part of their reserves into longer maturity, maybe even going out to 100-year maturities with lower interest rates. That would dramatically help the United States government, which has a history of running deficits every year, of really getting its interest expense down, which is now becoming the second largest line item in the US budget. Third and finally, leverage and use tariffs and security guarantees of providing protection to much of the world, at least with regards to our allies, to participate in the accord and encourage our foreign allies to adjust their currencies upward and favorably to them, or really to us, I guess, if you're Trump, as a part of this process. So again, I think it's helpful to understand that if they're successful in these things, what does that mean to financial markets? And we'll kind of talk through that. But first, I want to let you hear from Warren Buffett and Charlie Munger of Berkshire Hathaway on the trade deficit and the importance of not running trade deficits indefinitely. So let's listen to them before we talk about these other two.
The second question about the trade deficit, that's a very interesting thing, because when you run a trade deficit, what you are doing is you're trading assets of one sort or of another for goods beyond what you're sending abroad. So in effect, you are selling off a tiny bit of the farm so that the country can consume more than it's producing. If you run a net trade deficit, the country in aggregate is consuming less than, or consuming more than it's producing. And if you're a very rich country, you can't even see it, because if you run a trade deficit of a few $100 billion, compared to an economy that may be worth 40 trillion or something like that, you don't see it. But you're trading off a tiny bit of the farm every year to live a little bit better than if you just lived off the produce of the farm that year. And you can do it with IOUs if you've got a good record. You can't do it with IOUs if you're a country that's got a terrible record. So they have to denominate their debt in dollars. And of course, they don't have the ability to denominate a lot of dollars, and people don't want to accept a weak currency. So a weak country can't get away with doing that unless it's getting special type loans from agencies set up to do that. We can do almost anything we want in this country because we don't confiscate property, and we haven't destroyed a currency that the people have accepted, or in terms of payment for their goods over the years. But I basically think a significant trade deficit over a long enough time is a significant minus for the country. You won't see it though day by day or week by week or month by month. But eventually, if you trade for trinkets or whatever you're getting beyond what you're sending, and you trade away your assets, fortunately, some of the assets we traded not that many years ago, like movie studios and some of those things, the other people got the short end of the bargain on. But by and large, it's not a good policy for the country to run large trade deficits year after year. Charlie?
Well, that's certainly true if what you're trading for is trinkets or consumer goods or something. But of course, a developing country that ran a trade deficit to put in power plants and that might be a very smart thing to do. In fact, the United States once did that.
Yeah, we did it with railroads in a huge way,
But under modern conditions, do we look like a twosome that would love a big trade deficit?
No. It's one thing to build railroads with a process, but it's another thing to buy radios and television sets. I mean, it depends what you're getting. But by and large, we run a trade deficit on consumption goods, and that's not a big plus over time. Area 2.
So hopefully that was helpful to kind of get some perspective from somebody that's not in politics, even though I think historically Warren Buffett and Charlie Munger have been Democratic leaning in their voting habits. But just to hear, at least from them, two successful financiers that run one of the largest insurance companies on the planet, do believe that over the long run, we don't want as a country to run a trade deficit. We're effectively, as I like his way of putting it, we're selling off part of the farm each and every year, even though we don't really see it. And so that, again, is one of the things that I think that the Trump administration is trying to do. So what does that mean if they're successful? Well, again, as I said earlier, our exports become more competitive. Hopefully we'll have more manufacturing here, more private sector versus government sector jobs, greater GDP growth coming out of the private sector. But of course, the shortfall of that is that if you've got things that you import into the country, those things will necessarily be more expensive as a trade-off as to part of that policy goal. As it relates to debt and interest rates, on the next slide, I'm going to talk about that. And one of the things that I think I keep hearing is that there's clearly a desire to see interest rates get lower from market participants. I think market participants understand that rates being elevated in an over-levered economy, and we do have an over-levered economy, makes it vulnerable. I'll use the 2008 financial crisis tied to housing. Really, housing did not get in trouble until interest rates had moved up high enough, long enough in 2005 and 6 with high prices or overpriced houses that would then lead to something, 3 years later with a financial crisis. Not to say it's forecasting that again, but I'm just trying to suggest that falling interest rates eases financial conditions, which helps make the economy grow because more borrowing and lending necessarily will happen with lower rates. And I'll talk about that in some of these slides in a minute. But just to kind of give you some expectations of what market participants are seeing is that we went into this year assuming that we might see more rate cuts than we've seen when you look at the shape of the yield curve from market participants. And so what I would say is that here we are in June. We've not had one yet, which begs the question, are we going to see the Fed funds rate cut? And everything I see suggests we won't get a cut of maybe more than 25 basis points before September. But if we do go into 2026 with inflation continuing to moderate and growth continuing to moderate and perhaps even slow, that would be an argument for further rate cuts coming down the line, but not before the new year gets here. What does that mean for the bond market? Regardless of the investor type, chances are if you're a conservative investor or even a balanced investor, you're going to have some fixed income in your portfolio. In my view, and through the lens that I'll look at the bond market, at least the high quality parts of the bond market, I still think it's attractive. I showed this chart back in my December webcast, and it's the most interest rate sensitive part of the bond market. And when I say interest rate sensitive, I mean that when interest rates move the least little bit, the price moves a lot. And the reason why that's the case is because what we're looking at is a price chart going back to 1978 of the 30-year Treasury bond. The longer the maturity of a bond, the more price sensitive it is to interest rate changes. So for example, when interest rates were very low, when we were in COVID and the lockdowns, rates fell to almost nothing, bond prices went up. And since when interest rates go up, bond prices go down, you can see that the 30-year long bond went down about 43%. And so I've got an assumption in the back of my mind with if Trump's stated goals come to fruition and inflation continues to moderate and foreigners are willing to accept lower yielding debt on their reserves that they hold in U.S. treasuries that get termed out to, let's say, 50 or 100 years, that's a bullish argument that the long end of the yield curve may very well recover substantially in the next 12 to 18 months, which is why I've got these rising and implying trend lines. Again, don't know the future, but that would not be unlike what happened back in the early 80s. The bond market with the high and rising inflation in the late 70s would eventually peak, or excuse me, would eventually cause the bond market to fall a similar percentage in the early 80s. And then you would see a recovery as interest rates fell. So we'll see if that works out, but that gives me hope that the bond bull market may not be over. Turning to the U.S. equity market, I always like to show long-term charts. Long-term is defined in this case. This is a 100-year chart of the S&P 500. It's often stated, which is true in our industry, that stocks can expect to be earning an average annualized return of around 10% per year. That's true if you've got 50 years in almost every instance, but it's not always true if you have 20 years or less to invest. So I always like to talk about the conditions that set up these periods of time where you see a deviation of return substantially, at least, from that 10% average per year. So let's talk about when those happen. Number one, let's talk about the ones where you saw above average forward returns. Let's go all the way back to the Great Depression. The stock market had just fallen 90%. And from the 1933 low, you would see the stock market basically over the next 20 plus years appreciated almost 18% per year annualized. Likewise, at a significant inflationary related time frame during the 60s and 70s, you'd see the stock market bottom in October of 1974 right here. The stock market would then be set up to appreciate at well above that 10% average, basically for the next 25 years. That was about a 16% annualized return outcome. And then more recently, for many of us in our experience, the 2008 timeframe low through today, the S&P 500 has actually averaged around 16% annualized, going all the way back to that low during that time frame. And what those all had in common is you had just been through a period where you'd either had a 50 or as much as a 90% decline in a pretty deep financial crisis scenario, where the stock market would either get back down to this rising blue trend line that I've drawn on here, indicating a level of cheapness, and or commodity prices were no longer rising, they were to start falling. And so those are the things I'm going to focus on in several of these slides after this, because it's helpful to understand what are commodity prices doing, what are their likely direction, how's that going to influence interest rates, how's that going to influence commodity prices, how does that influence big blue chip indices like the S&P 500. Before we do that, though, let's go and talk about these time frames where it was not so pretty with above average returns and you witnessed below average returns. That'd be the 1929 peak, where you did make money from that peak for about 25 years until it recovered. You had the 1966 period to 1980, where returns were basically flat for that 16-year period. And then the tech bubble 25 years ago, back in 1999, that topped in March of 2000. In that time frame, the S&P 500 would basically trade sideways and not permanently exceed that March 2000 peak until 2013. So here we are today. We're at the top end of this channel. And as I said before, when the stock market gets to that top end of the channel, it doesn't guarantee it's going to crash or decline today. But it is an indication to me that we're probably up at expensive valuations, which we are, and I'll talk about that. Also, in the event that we've had rising inflation from commodity prices rising, that's having to be addressed by the central bank tightening financial conditions, that makes the stock market more vulnerable. The combination of those two, I should say, makes the stock market in general more vulnerable than normal. That's not to say there's not places to invest in equities, but the headline index like the S&P 500, the NASDAQ, the Dow Jones Industrial Average does have some vulnerabilities similar to past bubble peaks that are worth noting. Let me also notice in the near term, we're clearly still in a rising trend off the 2008 financial crisis low. I mentioned that simply because this blue line here that's on this chart, which goes back to this black line on it rather, which goes back to the 2008 financial crisis low. You've seen the stock market not violated on the downside yet. That's just a technical way of trying to say, hey, are we still in a rising trend or not? And I would say we are. And my short-term expectations is that that rising trend is going to continue through the summer and maybe even the early fall months. But as I'll talk about in a little bit, looking at monetary aggregates, looking at financial conditions, looking at money supply growth rates, not just in the United States, but around the world, there's some expectations that you might see those start to roll over as we get into the fourth quarter of the year. So I'm going to talk to how I'm looking for that and what I think that might mean for the stock market in the event it does break down at some point. Before I do that, though, I always like to go back and talk about one of the things I've just mentioned, financial conditions, and what determines if financial conditions are loose or restrictive, at least the way I look at it. And one of the ways that I look at it is looking at, well, what are short-term interest rates relative to longer-term interest rates? So for example, this black and red line that you see here is measuring what's the 2-year Treasury note yield, and then subtracting what's the 10-year Treasury note yield. So for example, if we see a reading up here that's high, that's by the way being measured over here, you've got a high spread between the 2-year Treasury note because it's about 2.5 to almost 3% below the yield on the 10-year Treasury note. And when that's going on in the United States interest rate markets, that's a situation where with those large spreads, interest rates, or excuse me, financial conditions are likely to be very loose. When you see loose financial conditions, you usually see banks able to make more money. When banks can make more money, guess what they tend to do? They're more likely to lend. And when money's demanded to be lent to, you see more economic activity. So that's why that's important to pay attention to. So anytime you see loose financial conditions for a sustained period of time, guess what the stock market's doing? Let's go back to it. The stock market's usually rising. And even as financial conditions become less loose and get to neutral, and then you get to a point where we call what I call an inverted yield curve. That's a situation where short-term rates are above long-term rates, as defined by this indicator being below zero, which is this red horizontal line. Once that's been going on for a long enough period, that's usually when the stock market stops going up. So again, if you notice that there, 25 years ago, it took about 6 months for that to happen before the stock market peaked and we had the tech bubble burst. It happened again in 2007. Took about 9 months before the stock market peaked in that episode. It happened very briefly prior to COVID happening. Well, of course, we've had substantial amounts of fiscal response to that, so there wasn't much of a drop there. But in this episode, we've had a record length of yield curve inversion, which is the Fed contributing to restrictive financial conditions to try to offset inflation and also offset dramatic amounts of fiscal policy stimulus, which is really what we've been witnessing in recent years. And so with that, we've not seen a stock market correction of size outside of what we saw in April this year, but it's still providing me what I would call a yellow flashing light to equity market participants in this index that is expensive. I showed this slide in December. I want to go back over it again. Now, why again is that important? Well, history would say the longer the yield curve has been inverted, the larger the drawdown the stock market experience should be expected to be. Now, the evidence of that is on this chart. In 1989 and 1969, for example, the yield curve had been inverted for around 150 to 200 days. That was not a long time in the history of yield curve inversions. You saw a 20% correction in the stock market before it would start to recover. Further out, and recent to my experience in the year 2000, the yield curve had been inverted for almost 300 days. When the tech bubble burst, you'd see a 50% drawdown over 30 months. 1974 and 2008, you had a longer yield curve inversion. Stock market would go down 50 to 58% in those two episodes. 1929 into the Depression, we had the 90% drop. And we're sitting here in 2025 now with the yield curve inversion that was from 2022 to 2024 that had been longer even than the 1929 episode. And again, I'm not expecting a Great Depression outcome per se. All I'm saying is that each of these circumstances where we've witnessed extremely long restrictive financial conditions has left investors having to be ready for a larger than normal correction. Stock market corrects on average 15% or so in a year. All I'm trying to say is that it would be my expectation that eventually, when the stock market breaks down from its rising bullish trend that's been in place since 2008 and is now expensive, that we might need to expect something larger than that based on this history. Why else do I mention that? Well, if you look at, again, the expensiveness of the S&P 500 through the lens of looking at its cash flow yield, I tell people the cash flow yield is like looking at the stock market like you might look at the bond market's interest rate. It's now, not surprising to anybody to say back in 2020, Was a 2 or 3% interest rate too low, given the fiscal and monetary response? And of course, everybody would say yes. Bonds were overpriced because interest rates were too low. Well, that's what this indicator is giving us on the S&P 500 right now. The cash flow yield on the S&P 500 is now below 3. That's only happened one other time. That was in the March 2000 timeframe. In the 2007 timeframe, when the stock market peaked, it had above a 4% free cash flow yield. And attractive free cash flow yields are usually when the stock market has got a cash flow yield of around 6, 7, or 8%, which is what we witnessed at the 2008 bottom. And again, that doesn't mean you have to see a crash anytime soon, but it is just a warning to investors in the S&P that you might want to start thinking about other areas of equities that have more attractive free cash flow yields, which is what I'm going to talk about in some slides in a few minutes. Now, why do that? Well, again, it's like investing in a bond with a more attractive interest rate when you do it. So if you look at the free cash flow yield on the Russell 1000, the S&P 500, the NASDAQ, they're all going to be below 3. And their PE ratios, that's their prices versus their earnings, are going to be historically close to double their averages. But there are companies out there that if you screen for them, you can go find much lower price to earnings ratios and resulting much higher free cash flow yields. You just have to know where to look. Number one, some of those places include value stocks in the United States, even in the large cap space. International value stocks, international emerging market stocks, they're all trading below their historical average right now, which implies if they move back to their average valuations that they normally trade at, you ought to see returns. And so even if the U.S. large cap growth component, which has performed the best since the 2008 financial crisis low, even if that component gets in trouble, it's not to say there's not places within the equity markets globally that might do considerably better. And these would be places I would be shopping. Some other sector-related areas I would be shopping that I mentioned back in December, of course, include the precious metals industry as well as energy stocks. The reason why I would start there is simply because they have the highest free cash flow margins. Free cash flow margins that are high lead to higher free cash flow yields. So that's why I like those two components within the commodity complex. Speaking of gold, I think it's also helpful to come back to most investors don't realize, and not that I'm an indefinite holder of gold or propose holding gold indefinitely, but if you're in an environment where you've got rising commodity prices that you believe will continue for some period of years in the future, gold is both a commodity and a currency. That ought to be a consideration for some portion of one's portfolio. And I think it's also just helpful to understand how has gold done in the last 25 years against, say, a broad index like the S&P 500. And that's what this chart's telling you. If you look at the total return back to 25 years ago on the S&P 500, it's up close to not quite 500% or fivefold. Interestingly enough, most people are not aware that gold's done more than double that, which is not a reason in and of itself to own it today. It's just an observation that it's amazing to me, such a major asset class that's owned by large institutional investors and certainly central banks as a reserve asset is rarely found in a typical investment advisory account. One other thing as it relates to gold and looking at how it's performing versus the stock market historically, I think it's helpful to look at these time frames where when the stock market's going up and doing better than gold, and then when you see a reversal in that relative performance, because when you see a reversal in that relative performance of the stock market versus the gold price, that's usually telling you you're close to the end of the stock market's uptrend in general, and you're also likely at the beginning of a trend of commodity price outperformance relative to the stock market. So for example, if you were to go back and look, this goes back into the 1800s. This was the late roaring 20s where the stock market in the United States and the Dow Jones Industrial Average just went almost straight up during the decade of the 20s. Gold back then didn't trade. It was just $25 or $7 an ounce, I think, back then. And you had the crash. Gold didn't go down, but the stock market certainly did. And when gold got revalued to $35 an ounce and the stock market started recovering, that was telling you, okay, the stock market's now back into a rising trend that would continue again into the mid-60s until we had commodity inflation start to rear its head. And then you see this time frame there from the mid-60s into that early 80 time frame where the price of gold goes up 25x while the stock market is trading flat for that 16-year period. Then, of course, what happens from the 1980s for the next 20 years, gold prices fall, inflation falls, and the stock market goes up. I think it was about 11-fold before dividends as measured by the Dow, until such time you see a breakdown in that relationship during the 2000s timeframe into 2011. So really since about 2011, you've seen the stock market do extremely well versus the gold price, but we've just recently had the stock market start to underperform enough against the gold price, not because the stock market's going down, it's just because gold's been going up more. And that to me is an early signal that commodity equities ought to really be looked at, not just because they're cheaper versus, say, the S&P 500 index, but they may very well have another multi-year tailwind of price appreciation ahead of them if commodity prices keep appreciating, which again is a tendency to happen over a decade at a time. So within the equity complex of commodities, one of the reasons why I own precious metal mining companies is really for two reasons. One, I've already stated, gold price is rising. Gold miners obviously benefit when gold prices are rising. But the other reason is that that particular sector tends to run opposite the broad stock market. And I've talked about this back in December. 25 years ago, as the tech bubble was beginning to burst and the Dow and the S&P were about to go down 50% over 30 months, this index of gold and silver mining stocks during that same time frame would go up about 500%. During the time frame the stock market was going down. That performance would continue to outperform those broad indices really for about that entire decade of the 2000s that gold prices and commodity prices were rising in general. And so once that turned over back in favor of owning and not owning commodity stocks like precious metals back into the S&P and the other more traditional investments for that following decade that would end really around COVID, to me, I started looking for, okay, are we about to flip back into a time frame like that early 2000s? And that's in fact what we're now witnessing, where, for example, the S&P, as I said at the beginning, is up about 3% on the year. Since gold's up 25% on the year, gold mining stocks, which are leveraged to the gold price, are up closer to 50% on the year. And then the final thing I'll note is that if you look at the yield curve, you'll notice there's a positive correlation to how, as the yield curve uninverts and financial conditions go from being restricted to loose, which they're starting to do, gold mining stocks tend to go in that same direction as well, while the broader blue chip indices like the S&P tend to have a tendency to eventually go in the opposite direction and downward. So with that, just to summarize the slides that I've talked about, going back to the beginning on the economy, I do think the back half of the year, it's reasonable to expect continued economic growth, but nonetheless slowing economic growth as we get towards the end of the year, particularly if DOGE is successful in any way, shape, or form, reining in some of the government spending influence that was in place between 2022 through 2024. That should also at the margin continue to influence inflation readings lower as we get closer to the end of the year, which again would imply we might get a rate cut in September and perhaps more rate cuts as we go into the new year. As I said, also, the uptrend in the broad indices continues, but if those big mega cap names that are in those main indices start to get vulnerable to earning disappointments, it's very possible that we might see that bull market end after the end of the summer. Finally, I didn't mention this yet, but I do think it's quite possible that we could see in another year or two, the Federal Reserve have to get involved in what we call yield curve control. What's that? It's just artificially suppressing interest rates. We saw that after 2008. They kept interest rates low to try to stimulate the economy. We saw great asset markets when that happened. I think this go round, if they have to start doing that in 2026 or 2027, that should be not only beneficial to bond investors as interest rates presumably fall, but that would also presumably be good for commodities, gold, and precious metal mining stocks as well through the balance of this decade. On a closing note, just to provide a few additional resources for those of you that may be interested in them. If you have a copy of the slide deck, as I mentioned before, not only can you go back and watch some of the earlier webcasts that I've done, some of these articles that are available in interviews, I've just found the feedback from them to be tremendous. This first article called Gold Revaluation gives you a good history in the article of the role of gold to governments and their central banks. And in this particular article that just came out in February, it does so in the context of the current Trump administration and what they're trying to do with their policy. The second is an interview from Michael Howell. He's one of the only people I've found that tracks global liquidity. And global liquidity through the measuring of global money supply is extremely important to follow, because when global money supply is expanding, which it is, that tends to benefit the rise in stock prices, not only here, but around the world. Michael Howell will tell you in that interview that he's expecting, as I am, that liquidity to keep expanding through the end of the summer. But after the end of the summer, he foresees a time frame where global money supply growth rates is going to start tapering off, which is one of the reasons why I'm wondering if the fourth quarter of this year doesn't seem to see a correction in equity markets. Finally, Hedgeye is a subscription that I use that's used by a number of asset managers here and around the world. Started by a gentleman named Keith McCullough. He's interviewing a guy that runs a healthcare ETF named Mike Taylor. Mike's one of the guys you want to listen to about all things related to markets, and they also get into politics. That interview was done 4 months ago, so you get to hear some of his thinking before the April correction happened, as well as some of his thoughts from talking to people like Vivek, which he's a personal friend of, about Doge and what they were thinking about at the time. So I encourage you to listen to that if that's of interest. And then finally, if any of the content in today's webcast makes you want to do an account review, don't hesitate to reach out to us. We want to do that, and any of the thoughts that we have in today's webcast makes you want to think about how you're positioned, or if you've got assets that you want to look at adding or us exploring with you your investment strategy and how these thoughts delve into that. Know that we're available to do that at no obligation to you if you're not a client. Finally, on a closing note, my next webcast will take place on Wednesday, December the 10th. And with that, I just want to say thank you again for taking some time out of your day. And I hope you and your family have a great July 4th